Debt market update, November 2023. G-Sec yields moderated during the month and 10-year G-Sec yield ended at 7.28%, 8 basis points lower compared to end October 2023. The movement in yields was driven by multiple factors, including unchanged policy rate by US Fed, fall in US yields on back of dovish commentary by Fed officials, decline in oil prices, etc. Corporate bond spreads widened compared to last month, driven by increase in risk weightage by RBI on unsecured loans and NBFC lending. Average interbank liquidity fell month-on-month, driven by rise in currency in circulation and forex sales done by RBI. FPIs bought debt worth USD 1.9 billion in November 2023. Cumulatively, FPIs have bought debt worth USD 5.5 billion in 8-month FY24. Outlook. RBI in its last policy meeting announced possibility of OMO sales, which led to yields rising in November 2023. However, in the near term, the risk of RBI intervening through OMOs is receding in view of average interbank liquidity being in deficit. The durable liquidity, however, remains elevated, and interbank liquidity is likely to improve in coming months as government steps up spending in the coming quarter. The outlook for fixed income remains favorable over the medium term in view of the following key drivers. Robust tax collections and growth in small saving collections limits risk of fiscal slippage and additional market borrowings. Moreover, net supply of SLR securities in H2 FY24 is significantly low. Inclusion of India's sovereign securities in JP Morgan Bond Index bodes well for demand outlook for G-Sec and can effectively cap any significant rise in yields. Core CPI momentum remains subdued on back of lower input price pressure and benign global commodity prices. Inflation expectations also remain well anchored and are trending lower. Growth likely to soften, driven by decline in fiscal impulse, moderation in trade, and private consumption. RBI is expected to maintain an extended pause. The bar for restart of rate hikes by RBI remains high, despite sharp rate hikes by US, as adequate foreign exchange reserves should keep pressure on INR at bay. However, there are counterbalancing factors which can put upward pressure on yields. Risk of RBI conducting OMO sales remains, but timing and quantum are uncertain. Regular food price shocks can keep headline CPI elevated and can adversely impact inflation expectations. SLR holdings of the banking system is high and credit growth robust. Further, the demand from insurance sector is likely to taper down vis-a-vis last year. Hence, incremental demand for G-Secs is likely to remain muted. Continued global monetary tightening and risk of rise in commodity prices, especially oil. Significant increase in global bond yields can have a rub-off effect on Indian yields as well. On an overall basis, in our view, yields are likely to trade in a range in the near term, although we believe that long end is likely to outperform over the medium term. While we continue to recommend investments into short to medium duration debt funds, given the sharp rise in yields in the past couple of months, investors could consider higher allocation to longer duration funds, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.